Hello, folks. Charlie Gipple here with CG Financial Group, an independent marketing organization based out of beautiful Des Moines, Iowa, serving agents that, sell a lot of life, annuities, and long-term care. Today, we're going to talk about that first one. Today, we're going to talk about life insurance, specifically some of the concepts when it comes to whole life insurance as well as indexed universal life insurance. Now, please do not mistake this video as disparaging life insurance, whole life insurance, or IUL, because if you know me, you know that I love these products. You know that I absolutely love these products, but you should also know that I'm a realist when it comes to some of the concepts that these products can sometimes be the funding mechanism for. And some of the concepts I'm going to talk about today, the primary concept is these banking concepts or the debt elimination concepts that we hear out there. They are good concepts if used correctly, but because of the complicated nature of how the products work, you get a loan from an insurance company, the collateralization happens against the surrender value and the death benefit, but yet the cash value continues to grow. And by the way, there are dividend rates. Dividend rates are 5%, but that's not really what the policy is growing by. With IUL, there's interest rates of 6%, 6.5%, but that's not really what the IUL is growing by. And it's just very easy for one, if they wanted to kind of talk in a way to where, the client can have their cake and eat it too, right? I've heard this a lot. Hey, with this whole life policy, it will grow at 5% tax deferred. And when you access it, ultimately, it's tax free. It'll grow at 5% compounded. And the thing is when you access the money, it's a loan. And the loan comes from the insurance company, which means that the money is still working for you. Your loaned amount is still in the policy working for you. Well, that is kind of true, but at the same time, you just told that person that it's growing by 5% compounded, and then you turned around and effectively suggested that when one takes a loan against the policy, that, the money is still working for them to the extent that you kind of mentioned in the first place, which is 5% growing compounded. It's very easy to confuse somebody if you really want to confuse somebody. And a microcosm of that is some of the banking concepts here that I want to talk about. So let me just jump right in here. What do I have here? I have an amortization schedule that we created here at my company. I'll share this schedule with any of you. You can basically just plug in whatever numbers you like, and it'll show you how long it takes for whatever debt that might be to pay off. So $250,000 mortgage, for example, it's a good rate on that mortgage, 3%. You plug that into your calculator, and that tells you that at $1,054, that is your payment to pay off that 30-year mortgage, in 30 years or 360 months, right? So you pay that $1,054, it hits zero at the end. Now, what happens a lot with some of these concepts is okay, you have this debt. You want to get rid of the debt. Why? Because you never want to pay another penny to those big bad bankers that have their massive buildings and mahogany desks and leather-bound books at your expense. You never want to pay another penny. So here's what we're going to do. And of course, I'm being a little facetious, but a lot of times what happens is, hey, let's come up with some additional money here, or heck, let's just pay the interest only on this thing and maybe use the rest of the money to fund a life insurance policy so we can wipe this debt out quicker than, say, 30 years. Now, that doesn't really happen with conventional 30-year mortgages. That's mostly with, say, like credit card debt and stuff like that, which, by the way, if it's like an 18% or 9% or 10% credit card debt, I'm for that all day long. This 3%, I just want to show you to level set it, and then I'll come back and say, but, if interest rates were higher, it would look like this. But anyway, that's usually what happens is, hey, you have a liability here that you have to pay, and that liability is, say, $1,054. So how do we come up with more money to fund a life insurance policy? And let's just say this is random. Let's just say that on top of the $1,054, we have a total of $2,000. So on top of that $1,054, I took $946 and I said, okay, I'm going to fund a life insurance policy. And with that $946 per month, I'm going to fund a whole life policy. It's going to be 40% base, 60% paid up addition. So it's the design that accumulates Well, that's maximized for cash accumulation, right? So what I did was I said, okay, at the end of year 30 on this amortization schedule, obviously the liability is 0 at the end of year 30, right? Well, what is the asset? So kind of talking net worth here, right? Assets minus liabilities equal net worth. So what kind of asset were we able to build by the end of year 30? Please pardon all these columns. I don't want to show the headings because it doesn't matter who the carrier is here. It's not about the carrier. This is a great carrier, a great product. But what this product does that has a dividend rate of, around 5.2%, what it has done, it has grown based off dividends, so the non-guaranteed column, it has grown our $946 per month, or $11,352 per year, to $565,000 by the end of that 30th year. By the way, what kind of internal rate of return is that? Here's a hint. It is not a 5.2% internal rate of return. It's a 3.09% internal rate of return. And it's a tax-free internal rate of return, which is very good, right, to have the tax-free nature of it. But my first point is no, it does not grow at whatever the dividend rate is, compounded. And then, hey, whenever you want to take a loan against it, it doesn't affect any of that. That's not the way it works. But it does grow a nice little war chest here to $565,000, right? So at the end of year 30, in my first example here, to where we just say, okay, so with $1,054 of your dollars, what you're going to do is you're going to pay that mortgage right there. That'll hit 0. And then with the other $946 per month, we're going to accumulate, say, $565,000, at least based off of the projections. Well, now let's go to the punchline. Let's go to where a lot of folks take this. Which is debt elimination, which if the interest rate on the mortgage were, again, say higher than 5%, I would be for this all day long. But sometimes it can be, hey, I have a whole life product, that's a hammer, or I have an IUL, that's a hammer, and everything else is a nail. Your 3% mortgage, let's wipe that out. So let's pretend that we're going to do that, right? So I took a random year in the future where the amortization schedule kind of crossed over with the cash value in the policy. It's a little more random than that, but I just took year 15, the end of the 180th month, and I said, okay, we're going to wipe this out, $153,682, which means that our $1,054 payment's going to shut off, right? It's going to shut off at least when it comes to the mortgage. But here's what we're going to do. We're going to take a loan against our life insurance policy of $153,682, wipe out our 3% mortgage, and within the life insurance policy, we're going to continue to pay that $1,054 going forward into the future. Now, how do you think that's going to look ultimately? Well, we know how this is going to look in year 30 to do apples to apples, right? In year 30, this is a 0% debt, right? Well, what does our asset turn into at the end of year 30? And again, this is just a simplified example. This is meant to be kind of a microcosm of some of the more complicated cases here. I try to distill this down. Well, at the end of year 30, our $946 per month, and by the way, we took a $153,000 loan out. Why is that only $141? Because technically we paid off $12,648 in that same year, so it nets out to a net loan of $141,000. And again, we continue to hold ourselves accountable. Well, what does the cash value, what does our net worth in comparison look like at the end of that 30th year period of time? It's only $532,000, right? Versus the $565,000. Why is that? It's because what we have done is we have wiped out a 3% mortgage in exchange for the rate that the insurance company is charging us on our cash value here, which is 5%. So what's happened is that $12,648 that otherwise would have wiped out our 3% mortgage by the end, Well, that $12,648, there is still a loan balance. And again, without showing you the header and which company it is and all that stuff, that doesn't matter. Just trust me when I say this is the outstanding loan balance that reduces the cash value down to $532,000. So this $532,000 is not $565,000. Why? Because of that loan against the policy that is still outstanding. It's still outstanding because this has a 5% interest rate assessed on the loan added on to the loan amount versus the 3%. So in our examples here, the first scenario would have provided the most quote unquote net worth for our client. Just looking at this stuff in a vacuum net worth wise, right? Would have provided the most net worth to the client. Now, I haven't done it yet, but I would be willing to bet that if I took that mortgage math earlier and plugged in a 5% mortgage rate, which would have increased the payment, required for the mortgage, which would have decreased the amount we could put into the life policy here, in order to net out or in order to sum up to $2,000, I would be willing to bet that these two scenarios would be pretty much identical. Why? Because you're trading a 5% rate for a 5% rate. In this scenario, what we did is we wiped out a 3% rate for a 5% rate, and that doesn't make any sense, right? Outside of the behavioral stuff. The behavioral stuff that I love about life insurance is life insurance can be a forced savings mechanism, which can be good for a lot of folks, to force yourself to save, to force yourself to accumulate that $532,000, for instance, over here, right? So that's some of the behavioral positives to life insurance. But once you get below the rate on the life insurance policy, when it comes to replacing that other outside debt, if it's less than the life insurance policy rate, that's when it gets a little harder for me to justify. Now, of course, if we were to wipe out 15 years into it, say an 18% debt with this 5% debt, I would do that all day long, every day. And how is the insurance company able to guarantee only a 5% rate on that debt, which, yes, it does impact the surrender value, right? How's the insurance company able to give, say, only a 5% loan rate on that versus a 10%, an 18%, especially if somebody has bad credit? Well, because it's a very safe loan for the insurance company. Why is it safe? Because the cash surrender value and the death benefit is collateralized should the client either pass away or cash out their money, right? So I hope that makes sense. In short, here is my point. I like the debt elimination strategies, but not everything is a nail when you have a hammer, right? If you're wiping out debt that is more expensive debt than the debt that you would have within your life insurance policy, then go for it for the most part, right? Hope that makes sense. Again, Charlie Gipple, CG Financial Group.